China's significantly lowered economic growth target signals a fundamental shift, sending ripples across global markets and altering the landscape for international trade and investment. Beijing has unveiled its new economic growth target for 2026, setting it at 4.5 to 5%. This marks a significant shift, as it's the first time China has downgraded its target since 2023, and notably, it represents the lowest growth target set by the nation since 1991. The decision, announced by Premier Li Qiang at the annual National People's Congress, signals a more cautious outlook for the world's second-largest economy. For businesses and markets worldwide, this isn't just a number. It indicates a potential slowdown in production and a recalibration of global demand, impacting everything from raw material prices to consumer goods. For years, China's economy has been a locomotive for global growth, often exceeding its ambitious targets. To truly grasp the significance of this year's lowered goal, let's look at China's GDP performance over recent years. In both 2024 and 2025, China's economy successfully achieved its around 5% growth target. This consistent performance has shaped global expectations. However, the new 4.5 to 5% range for 2026 is a deliberate adjustment, reflecting an acknowledgement of persistent domestic headwinds and a strategic shift towards quality over sheer volume. What's behind this strategic recalibration? Several critical domestic challenges are forcing Beijing's hand. Firstly, a protracted property downturn, which began in 2021, continues to weigh heavily on investment and household confidence. Real estate accounts for an estimated 65% of total household wealth in China, so its struggles have a broad impact. Secondly, weak domestic demand and persistently low consumer spending remain a significant concern, with many Chinese households reluctant to spend amid economic uncertainty. Adding to this, deflationary pressures have gripped the economy, with the producer price index falling for 40 consecutive months by January 2026, and consumer inflation remaining flat in 2025. These combined factors create a complex landscape for policymakers. A slowdown in the world's second-largest economy inevitably creates global ripple effects. China's reduced growth ambition means potentially lower demand for raw materials and commodities from countries like Australia, Brazil, and across Africa. Less goods produced in China could also disrupt global supply chains, affecting manufacturing sectors worldwide. While a slower China might alleviate some inflationary pressures in certain markets, it could also lead to Chinese firms pushing more exports into global markets, intensifying trade tensions, especially with the United States and Europe. Yet China is still expected to contribute approximately 30% to global growth, serving as a significant anchor for the world economy. In response to these challenges, Beijing is pivoting its economic strategy. The government aims for high-quality growth, prioritizing structural reform and innovation in high-tech industries over pure expansion. To support this, China announced an expansionary fiscal stance, with its deficit-to-GDP ratio set at 4%, unchanged from 2025. This robust spending includes programs to boost domestic consumption, like earmarking 250 billion yuan for consumer goods trade-in initiatives. Furthermore, the government aims to create over 12 million new urban jobs, maintaining the urban unemployment rate at around 5.5%. Analysts from Goldman Sachs and ING project China's GDP growth for 2026 to be around 4.8% and 4.5% to 5.0% respectively, reflecting a pragmatic yet determined approach. The decision to lower the growth target marks a new chapter for the Chinese economy. It signifies a long-term strategy where the emphasis is shifting from rapid export-driven expansion to a more sustainable model fueled by internal demand and technological advancement. While this path may bring a period of slower growth, it's a calculated move to build greater resilience against external shocks and foster higher quality development. Global investors and businesses should monitor Beijing's policy implementation closely, especially in areas of domestic consumption and high-tech investment, as these will define China's trajectory in the coming years.
This is GeeseFinance.